Hey everyone, happy Thursday, December 7th. It's about 11:40 a.m. on the West Coast and time for another market update. Going back to last week, we ended the week, the average conventional rate was about 7.15, down from a peak in October above 8. So that was a nice little rally. Let's see if things have continued. And this week is jobs week, which is very important. We know the Fed's paying really close attention to all this job stuff. So first stuff we got this week was we got the October JOLTS report, so job openings. And so let's take a closer look at this stuff. Came down to 8.733. Missed expectations by quite a bit. And then they also downgraded the previous month from a 9.55 to 9.35. So another one of those negative revisions. So not only did it miss this month, but September's numbers got revised lower as well. And this chart's pretty interesting. You kind of see the peak above 12 million back in March in 2022, down to 8.733 earlier this week. And then if you look, you can see the ratio down here of openings of jobs to unemployed workers. So that got over 2, which is a lot. So for every job, there was 2 job openings for every unemployed worker. Now we're down to 1.3. So that's something the Fed pays close attention to. So it's good to see that on the way down. And the next thing we got was ADP. JOLTS was for October, ADP is for November. So a little bit more recent. As you can see, the headline missed. The headline was supposed to come in about 130,000. It came in at 103,000. October was revised down again, another one of those negative revisions from 113 to 106. As you can see, these different industries dropped off a little bit. Services still added 117,000 jobs, but you can see leisure and hospitality dropped 7,000. And as we've been talking about for a while, when COVID happened, leisure and hospitality service workers, they're the ones that got laid off the most. So that one got hit the hardest. And so that means they had the most jobs to fill once things open back up. So we've been having that, support in the jobs. All these jobs reports have been showing a lot of leisure and hospitality job gains over the last year or so. So now we're finally seeing that, taper off. And then this is the first report we've actually seen it turn negative. And Neela Richardson, who is the economist for ADP, basically called it an end of an era, based on what's going on. And then we can see wages are decelerating as well, which is important. Not that I want people to make more money, but the Fed's paying close attention to that. The more we're making, the more we're spending, the higher inflation goes. So this is all good for inflation. And then another ADP, just to show you real quick, I just wanted to show you guys this visual of, these job reports where they've gone down. So back in June, this was about 450, it looks like, down to about 100, 103, 106 last month. So, again, coming down pretty quickly. So that was, good to see. Not, again, that we don't want jobs available, but we know the Fed is paying really close attention to that stuff. Next thing we got today, job claims. And again, this shows the job market staying pretty tight, though. People are trying to hold on to their employees, are trying not to lay people off. Estimated was about 222K. It came in at 220, so a slight miss. Continuing claims dropped a slight amount, but there's still the second highest amount since I think 2021 or something like that. So, basically, again, people are, employers are trying to hold on to their employees, but once those employees do get laid off, they're having a harder and harder time finding a job, out there. Next thing we got was CoreLogic and Black Knight, both their October appreciation. So we always want to pay close attention to this stuff. First numbers for October, they both went up 0.2%. Both are on year-over-year paces around 4.6, 4.7%. And then the 2023 pace, we're at about 7%. So as you can see, all these different metrics, about 6 to 7%. Still waiting on those October numbers for a few of these others. This Zillow one at negative 0.1. This might be an outlier. As you can see, they were on the higher side down here. So the way they come up with their numbers might be a little bit different than everybody else. But good to see for current homeowners that home prices stayed in there. 6% gain for the year is great for homeowners. Great for people that bought in January. Not so good for people that stayed on the sidelines and decided not to buy. Next thing we got, some miscellaneous. So CoreLogic, they come up with a couple different reports. They have this appreciation report every month. They do a loan performance report and some equity reports. So let's take a look at this loan performance report. So as you can see, this is basically how people are doing, paying back their loans. So this is important for my industry. It's important for the overall healthy economy. We don't want, their housing bubble to happen. So as you can see, compared, the gray is September 2023. The green is September 2022. As you can see, they're kind of hanging in there, dropping a little bit of rise here in the 30 to 59 day past due. But then you can see 120 days going down. Foreclosures at really low levels at 0.3%. So overall, a lot different picture than things were back in the housing bubble. And then the other thing that came out, like I said, is an equity report. That shows right now the average amount of equity a current U.S. homeowner has is about 58%. Back in the housing bubble era, it was about 19%. So people have a lot more equity in their homes than they did back then. A lot more options. If bad things start to happen, they have that equity to take advantage, pay off some bills, do things like that. So next thing we got, so the average 30-year came down to 7.05. The ADP job report and the JOLTS report really were big wins in our favor. But we're waiting on the BLS job report tomorrow. That's the big one. And that's, the markets we've had positive days the last few days, but not as much as you expect with those blowout job numbers. But it's nice to see us getting close to that 7 number. Hopefully we can duck beneath that and, start making our way back down below 6. Important dates coming up. Like I said, we have the big BLS jobs report tomorrow. Right now, they're expecting about 180,000 jobs created, which we think might be a little high. And then they're also expecting the unemployment rate to stay at 3.9%. So if those come in as expected, we'll probably have a pretty muted reaction. If those come in our favor or a lot in our favor, maybe we break through some of the resistance that the markets are having. That things have dropped quite a bit over the last, like I said, month and a half or so. So, obviously this affects mortgage rates, but these commodities are also being traded, mortgage bonds, U.S. Treasuries, things like that. And so when you have big rallies like this, people tend to stop for a second and cash out. So we see that happen quite a bit where, with a big rally like this, some people decide, hey, I don't know if this rally is going to continue. Why don't we, cash out some of these profits? So some of the technical stuff is kind of keeping this from dropping as much as we like. But like I said, BLS coming up tomorrow, CPI and PPI next week, and then the Fed next Wednesday. So the Fed's going to make their announcement. Right now, everybody's saying they're going to pause. Not much chance of a hike, or cut. No chance of a hike right now, which is awesome. We don't want that. But here's, to give you an idea of what the odds are right now, according to the markets, about cuts going forward, because this is really when we're going to see those mortgage rates start to come down, once the Fed starts cutting. So as you can see, this is December 13th meeting, 0 chance of a cut right now. January meeting, 13% chance. So starting to creep in there. Not a good odds. You don't want that, those odds, but 13% is better than 0. And then March, you can really see that's when the markets are saying we they're thinking they're going to cut. The Fed might have different ideas, but March 20th meeting, 60% chance of them making a cut. Then May, you see it kick up to 88%, including a 38% chance of a 50 bip cut. So, half a point cut. So as you can see, as the year goes on, the market gets more and more confident that they'll be cutting. That's something we want. That will be good for mortgage rates, like I said. But it also might, connect with the fact that the economy's slowing down a little bit. So let's hope everybody, everybody keeps their jobs and things like that. But on the mortgage rate side, it'll be much appreciated if the Fed starts that cutting cycle. So, if anybody needs anything at all, please don't hesitate to reach out. I hope you guys have a great week and have a great day.